Hello everyone and welcome to our podcast series in Classical Political Economy by the Vinson Centre for the Public Understanding of Economics and Entrepreneurship at the University of Buckingham. The Vinson Centre runs a series of programs in economics and related fields designed to promote a wider understanding of classical liberal economics and how markets, trade and entrepreneurship promote welfare in a free society. I'm Dr. Juan Castañeda, Director of the Vinson Centre, and today we'll be hosting Geoffrey Wood. Geoffrey Wood is Emeritus Professor of Economics at City University Business School in London and Emeritus Professor of Monetary Economics at the University of Buckingham. A graduate of Aberdeen and Essex Universities, he has worked in the Federal Reserve System and the Bank of England. Overseas, he has advised several central banks and national treasuries. He's an advisor to several financial institutions, 2 pension funds, was an advisor to the Treasury Select Committee in the House of Commons and to the Parliamentary Banking Commission until the Commission ceased to exist on the publication of his report. He is also a member of the Vinson Centre's Academic Advisory Council. He has authored, co-authored, or edited over 30 books and has published over 100 academic papers. His fields of interest are monetary economics, monetary history, and financial regulation. Today, we'll discuss with Geoffrey his recent contribution to the Journal of Economic Affairs with the title The Search for Stability, a review article published in February 2023. You will find more details on the article in the description section of this podcast. Geoffrey, in your article, you discuss financial stability and review 2 recent books on the topic, one by John Danielson, The Illusion of Control, Why Financial Crises Happen and What We Can Do and Can't Do About It, and Alex Pollock and Howard Adler's Surprise Again, the COVID Crisis and the New Market Bubble. Since the global financial crisis, there has been a growing interest in financial crisis, and in particular, which policies can help us prevent a major financial crisis in the future. However, the definition of what a financial crisis is doesn't seem to be self-evident or even unanimous. So could you please start by telling us what a financial crisis is and what makes them so different as compared to any other standard crisis?
Well, let me start a little way back. You said there's been interest in preventing financial crises. People may think they're trying to prevent financial crisis. What they're simply trying to do is make firms more stable. Making individual firms more stable is not necessarily a way to prevent a financial crisis, because it forgets that every financial firm is embedded in a system. And I wanted to start that way, because it then leads me to your question 1, which is, what is a financial crisis? It was something that central banks, or a central bank, I should probably say, knew how to deal with before it had really thought about what it was. Because how to deal with it was developed in Britain, in England, strictly speaking, in the 19th century, the early 19th century, first of all, quite appropriately, by Francis Baring, the family whose bank failed twice. Then by Henry Thornton, Walter Bagehot, and various others. And they focused on a system without thinking what it was. They thought the important thing was to preserve the stability of the banking system. Now, why was it important from their point of view to preserve the stability of the banking system? Because if the banking system gets into trouble, then the transmission of credit from lenders to borrowers slows down. Then the money supply collapses as people start to hold cash rather than deposit with banks, so banks can't make loans. And these things combine to produce possibly a severe and long-lasting recession. The classic example of that was, of course, the Great Crash in the United States and the Great Depression of 1929, which in fact continued until the Second World War. They focused on the stability of the system, not the individual firm, because it was the system that mattered. If any one firm failed, that was undoubtedly inconvenient at best for those who deposited with it. But for the economy as a whole, it generally didn't matter very much. So what matters is the stability of the financial system as a whole. And I emphasize as a whole, and indeed they focused only on the banking system. We might come later to whether other institutions matter. But the crucial thing is that a financial crisis is a crisis which affects the whole or a large part of the banking system.
So in your article, you refer to 2 different types of banking crisis: liquidity crisis or versus capital crisis. What's the difference between the 2?
Well, first of all, liquidity crises are really the common type. A liquidity crisis is when a bank let's stick with the example of a bank for the moment. A bank cannot pay its depositors. They scramble to get their cash. Other customers at other banks see this happening and scramble to get their cash. And in the extreme, one bank after another collapses, simply because they're short of liquidity, short of cash. What you call a capital crisis is when this starts off not with a bank running out of cash, which is actually unlikely in a modern system, certainly. If the bank is sound, it's got lots of capital, lots of funds to pay its creditors. But if a bank happens to be short of funds to pay its creditors, that bank gets into difficulties. And if individuals, customers at other banks don't realise that this bank is actually short of funds and is unusual in this respect, they can scramble and so a liquidity crisis starts. So a capital crisis is a trigger, if you like, for a liquidity crisis. There's never been, so far as I know, a pure capital crisis. When Barings Bank failed in the 1890s, that would have been triggered by a capital crisis, capital shortage, because Barings was very short of capital. Partly because it was taking risks and partly because it had lent money in Argentina. The Argentinian government defaulted, the Argentinian central bank defaulted. So understandably, Barings didn't get its money back. The bank was short of capital. Had that bank failed, it might have triggered a liquidity run in London banks. This was averted by the Bank of England and other banks getting together and bailing out Barings. So that would have been a crisis started by a shortage of capital, and that really is very, very unusual.
So, in case of a liquidity crisis, how should the National Central Bank respond?
The National Central Bank should respond really as Walter Bagehot, the 19th century economist, and Henry Thornton before him advised. It should lend freely. Now, this nonsense about lending to a solvent bank is simply silly. You cannot judge in a matter of hours whether a bank is solvent or not. You lend on collateral. In other words, you lend on security. It doesn't have to be as good collateral as you would normally insist on. You take a few risks to prevent the crisis. Nor should you should lend at a somewhat higher rate than usual, simply to ensure that you're repaid quickly, and also because you're taking on slightly higher, you, the central bank, are taking on higher risks than you usually do. But this nonsense of a penalty rate is also, if you lend at a penalty rate, then of course you impose a penalty on the institution, and that would drive the institution into difficulties which you don't want to do. So you lend freely on goodish security and at a slightly higher rate than usual. This stabilises the system if it's short of liquidity. Then when the panic is over, you can unwind the injection of liquidity. And if it can move forward a little, that's exactly what the Bank of England and other central banks have done in more recent years. You mentioned two of the books in this review article, one by Alex Pollock and a colleague, and the other by John Danielson. Alex Pollock is particularly good at the point I'm talking about now, because the Federal Reserve, when it was established, was intended to have, among other things, what they call an elastic currency, a central bank which could lend freely at a time of crisis. A very good thing. But the central bank in recent years in the US, and not just in the US, in Britain and many other countries, has had a currency which is elastic in an easy direction. It doesn't tighten up when the crisis is over, so the crisis is followed by inflation, and that is what we're seeing to different degrees in countries now. If we take, for example, two economies which are very open to foreign trade in the present crisis, very dependent on imported oil and gas, we can contrast Britain and Switzerland. The inflation rate in Britain, depending on the measure you use, was over 10%. In Switzerland, it's pushed up towards 2.5%. The one difference is the Swiss central bank controlled monetary conditions, the Bank of England didn't.
So you just set up what is the classical criteria for a national central bank to intervene in terms of a liquidity crisis, following the so-called Bagehot rules. Were these rules followed during and in the aftermath of the global financial crisis?
To an extent, not as much as they should have been. They were followed up to then. They were followed in the 19th century. They were followed in most of the 20th century. I say most of, because the Federal Reserve is really very hard to explain. In the immediately aftermath of the First World War, in 1919, in fact, there was a banking panic in Europe. The Federal Reserve behaved exactly as it should in the United States. The Federal Reserve behaved exactly as it should. It injected lots of cash to the system, and when the panic was over, it withdrew it. In 1929, it didn't inject cash fast enough, so the money supply was contracting, and the Fed was always chasing after money supply, but it fell very severely, and they had the greatest depression in recorded history, and a very long-lasting depression as well. So most of the time, the central banks behaved sensibly. They injected cash into the system. After the global financial crisis, they tightened up a bit, but to my mind, not enough. but not as loosely as they have the one is grow now.
Because the point on setting up this rule of an elastic currency in case needed, you provide liquidity in case needed, but you also withdraw that excess.
Exactly. If you think about elastic, you stretch it,
yeah.
you got to go and it pings back.
That's the principle.
That was intended by the phrase the elastic currency, or the elastic that they used recently, stretched and didn't ping back.
But that hasn't been the point, clearly, in the aftermath of the global financial crisis.
Absolutely not.
Quoting from your article, firms must be allowed to fail. To summarize so far, stability, and you refer to financial stability in your article, is important in the banking sector, and so is failure. We want system stability, not firm stability, end of quote. Can you explain why it is compatible to let individual firms fail while focusing on preserving the stability of the whole financial system?
Well, an individual firm can fail, provided there's an appropriate legal framework in place to close this firm down. Well, we have it in the United States, actually. You can close it back down over a weekend. It opens with new management, usually the Federal Deposit Insurance Corporation takes it over, pays off the creditors, or maybe keeps it going and sells it on, pays off the creditors and the depositors, unwinds the loans and closes the bank gradually with no knock-on effects in the system. There has to be a mechanism for orderly closure of an individual institution. We have it in this country, but to my knowledge, the biggest one we've used it on so far is the Dunfermline Building Society, which is not exactly a major financial institution, so it hasn't been tested. But it's of the essence that if an institution gets into difficulties, it is closed. It should collapse. It should close in an orderly fashion. Just as, say, a major retailer, if that were to get into difficulties, it wouldn't slam its doors overnight, but close in a reasonably orderly fashion.
In the last few years, and very much in the aftermath of the global financial crisis, emphasis has been put by national and international regulators on crisis prevention. And we have seen a significant tightening in bank regulation. Do you think it has been the right approach to preserve financial stability and maintain a safer banking sector?
Absolutely not. Because these regulators have no better foresight than anybody else. They don't know the kind of problems that are going to come along. They should concentrate on setting up a system whereby an individual institution can get into difficulty without the rest of the system getting into difficulties. The way they're going is making every institution very similar. If you look at their balance sheets, if you look at their behaviour, you can scarcely tell them apart. That means they're all exposed to the same kind of shocks. So the system is exposed to a common shock. That's a great mistake. They should let institutions make their own choices, and if these choices happen to be wrong and there was a lot of money, I'd have to close down what was done in an orderly fashion. The British banking system, after all, was for many years the most stable banking system in the world. There was no banking crisis in Britain, no banking regulation, I should say, in Britain until 1979. The system was then entirely unregulated apart from normal companies law, and yet the system was highly stable. There's more than one part to explaining that, but an important part is if we remember the names of British banks. The British Linen Bank, the Bank of Scotland, Barclays Bank, banked in East Anglia. Then there were banks on the west coast. There was the Midland Bank. These banks had different kinds of balance sheets, different kinds of customers. So the system wasn't always affected by the same shock. Diversification of what bankings do and how they do it is an important part of financial stability, simply because we can't see what is coming.
Well, thank you very much for joining us, Geoffrey. It's been a fascinating discussion. If you want to know more about financial stability and the role played by national central banks in addressing banking crisis, you can access Geoffrey Wood's article on the Journal of Economic Affairs page online and on the Vinson Centre's website. Thank you all very much for listening. This podcast is edited by the Vinson Centre at the University of Buckingham. You can visit our website at vinsoncentre.com to access our podcast series and know more about the programs and events we host, both in Buckingham and in London. Please subscribe to our newsletter if you want to receive timely information on the Vinson Centre's agenda.